These 5 stocks in the last stock market crashes, I'm talking 2001, 2008, COVID, have all done the exact same thing. And that is tumble from near all-time highs to record lows. I'm talking stocks falling 50, 60, 70% in a handful of months, causing absolute turmoil for people's portfolios. But that was the past. What about today?
We went back to a still high 45% probability of recession.
Odds of a recession at 45% within the next 12 months.
Ascribe around a 45% probability of recession.
With Trump's trade war and tariffs with China, with the economic uncertainty and the stocks being volatile week after week, this reminds me a lot of the last few recessions. And trust me, I've seen these signs before as a Wall Street pro spending 10 years investing professionally. I want to make sure you guys know the 5 sectors and stocks that I think are worth avoiding in this economic downturn. Let's dive right in. Number 1, oil and gas. Oil and gas is an absolute roller coaster of a sector, primarily driven because of commodity prices and geopolitical and economic turmoil. Plain and simple. As the wind blows, this sector blows as well. Why is it unattractive right now? Well, quite frankly, oil and gas production, exploration, and services is significantly tied to economic activity. When the economy slows, demand for some of these products and services slows as well. Let's take 2008, the Great Recession, for example. Crude prices, which is one of the key commodity inputs that drives the overall sort of health of the oil and gas sector. Crude prices fell nearly 70% in 08. I'm talking from $147 per barrel to a mere $44 per barrel. All because of economic slowdowns and the recession. And oil and gas stocks specifically were brutally hammered during that time as well. I'm talking, on average, down 40% during the 08 recession. Now let's talk about today. Today, we have Trump imposing tariffs on imports, a lot of those being some oil and gas products as well as tariffs on different pieces of equipment that is used by a lot of these oil and gas companies, so their input costs and COGS are going to be up as well. This is painting a pretty bad picture for the oil and gas sector. Let's take Halliburton, for example, one of North America's largest oil and gas exploration and fracking companies. This business in 2008 fell 65% because of the economic downturn. And in 2020, when COVID hit and economic demand for oil and gas services plummeted as well, this stock also fell around 50%. Now, I'm not hating on Halliburton, but I'm just showing you that such a volatile and exposed sector in an economic downturn, which we could be seeing in the next few months, possibly next year, this is just not a great stock to hold. And if you don't believe me, just hear from the CEO himself. Look at what they're saying in some of the earnings reports and forecasts that they have and what they're producing publicly to shareholders. They're letting them know that this is going to be a tough year for their business because of what's happening with tariffs, economic uncertainty, oil and gas demand. It is just not a pretty sight to see for operators, employees, and especially stockholders in a particular business. All right, so let's move on to number 2. Number 2 is renewable energy. Now look, I'm a certified tree hugger. I love renewables. I believe in climate change, and I want to do my best to protect the environment. But I'm an investor first. This is Kenny Finance talking here. And one of the worst sectors you can have exposure to right now is solar stocks. Solar stocks rely on 3 key things. Number 1, demand for their solar products. Number 2, economic incentives to allow for folks to be able to afford them. And then 3, a resilient supply chain to get a lot of these solar panels, which are made overseas, into the US. Now let me just paint this crazy picture for you. Number 1, demand. We are seeing tightening consumer budgets largely due to stocks falling, economic depression, level of activity, and people are just scared and fearful right now. And odds are they're not trying to install a $10,000, $20,000 plus solar panel on their roof if things are a little bit tricky in their wallet. And then number 2, the economic incentives to allow for folks to afford it. Traditionally, you can go and purchase a solar panel using credits to where you buy a solar panel, government gives you a certain amount of credits to cover that cost, and it doesn't have that significant of a cash outflow from you personally. So it kind of makes sense. And largely this was funded by a program called the IRA. Inflationary Reduction Act. And this is a $370 billion program funded by the government that allows for the growth and the implementation of a lot of renewable projects. Now here's the issue. This program specifically is targeted by the Trump administration, and it is being dismantled as we speak. So what does that mean? The solar sector is collapsing as well. And then thirdly, we're going to tie all these things together. Thirdly, a resilient supply chain. Well, guess what? We hear the story over and over, but tariffs. Tariffs are impacting every single piece of an overseas supply chain, especially solar panel manufacturers. So guess what? Solar panels coming from China, trying to come into the US, are going to be a lot more expensive. So the prices that they're going to be selling to customers at are going to be more expensive. But here's the issue. Customers don't have the wallet to do so because they're in an economic tight situation right now, because the Inflation Reduction Act, which gave them tax credits to afford these things, is being dismantled. You get the picture we're painting here? Don't touch solar right now. Number 3, automotive. This one hits home, and it kind of hurts because I'm from Detroit. Detroit is the motor city, the automotive capital of the entire world. I'm talking Ford, GM, you name it. Cars are, my dad was a race car driver. I'm a car guy, all right? But I'm also an investor. And the key thing is I'm not allocating capital to automotive stocks given the current macro environment. In 2008, during the Great Recession, auto sales fell 40% in that year. And that is largely due to cars being big ticket purchases and big ticket items. And the key thing that a lot of these auto manufacturers like Ford and GM rely on are their new car sales, not the used car sales. Like, those are still kind of affordable for a lot of consumers, the new car sales. And the key is when consumers are hit on their stocks and their wallets, they are not trying to go buy a fancy 2026 brand new Ford F-150. Plain and simple. If anything, they're trying to go and purchase, if they need it, a used vehicle to reduce the overall cost. But new car sales, those typically take a hit. Also, by the way, a lot of these cars, unfortunately, are no longer made in Detroit and the Motor City. They're made in places like Mexico as well as overseas because the supply chains are cheaper in those regions. And guess what? Trump has hit all of them with tariffs. So let me paint the picture of what it could look like if we hit a really deep recession. In 2008, Ford stock crashed 70%. Now, we haven't formally hit this thing called recession, but I'm telling you now, we are seeing signs of Ford's resilience in this economic environment start to dwindle, largely because of the tariffs discussion. Every single week, there's a new tariff news driving Ford stock up a lot or down significantly. And most of the news has been negative, so the pressure on Ford stock over the last 6 months has been negative. Just imagine when we hit an official recessionary type of environment for consumers and the economy, and geopolitical nonsense just gets even crazier. That 7% dip, that's some real shit for investors. And I'm trying to help you protect your dollars and let you know that if you're trying to deploy new dollars in the automotive sector, now I don't think is the best time. And look, guys, I don't want to spook you for any of this stuff. I am incentivizing you to make smart money decisions and think about what is the best use for your dollars of putting capital to work in the markets. Because the one thing I want you to do is have exposure to American businesses and investing in the stock market. Now, the best thing you can do is invest in index fund. We'll talk about that later. But I don't want you guys to have over-indexed yourself into a particular company or sector, especially one of the 5 that I'm listing right now. So if you appreciate that type of support from me, it means a lot to the channel if you can smash that subscribe button as well as the like button as well. Because look, we're trying to help you guys make smarter money decisions to take your dollars and your wallets to the moon. And plain and simple, you're not going to go to the moon if you're falling 50, 70%, all because of a recession. So let's try to protect your downside. All right, moving on to number 4, home builders. I'm not talking about repair folks and home services. I'm talking about new construction home builders, like new subdivisions popping up, new developments popping up. These are folks building the fancy, new, cool, modern mansions. Not even mansions, just new houses in general. And this sector is a sitting duck during a recession. Housing is just broadly cyclical in nature. Now, how tied and correlated it is to economic activity is extremely intact. They're like 2 peas in a pod. When the economy is booming, people are building houses. When the economy is collapsing, you see a lot of homes with the frames up sitting doing absolutely nothing and no folks buying brand new homes. Plain and simple. Let me paint the picture for the overall home builder ecosystem right now. First and foremost, we're in a home affordability crisis. The average American cannot afford to buy a brand new home. So home builders are broadly experiencing this crisis and facing a lot of tightening of budgets because what they're building is just not selling. The world isn't like when it was in the 20s and 30s when houses were like $17,000, $15,000. No, average home prices are like $400,000 plus in the United States. And that's not even in the super big cities like California, Miami, New York, etc. these are becoming absurdly priced homes in average and normal cities. And then the tariff situation. I know this is starting to become a tariff video, but tariffs might be the main thing that kicks us off into a recession. But a lot of the products, wood, the equipment, the bolts, the frames, the roof, all the stuff, some of it's made and produced in the United States, but not all of it. And you're seeing rising costs of these products to be sent over into the US because of tariffs or because of sort of like tariff and competition. This is making it insanely difficult for a lot of home builders to have a cheaper cost basis. So with the rising cost on their end, with consumers not really having the dollars to afford these brand new homes, what happens? They're kind of being squeezed here. And what does that do? That adds downward pressure to the stock. Let's take Lennar, for example. In 2008, this stock fell 80% during the recession. And that's a little bit of an overreaction because the 2008 crisis was a housing bubble, right? That's what caused this entire discussion of a recession. Now, right now, we're not in a crazy housing bubble, but we are in sort of an economic depression of activity. So you're not gonna see this stock fall 80, 90% this time around, I hope, knock on wood. But what you might see is sort of significant downward pressure, 20, 30, 40% plus, because these new home builds just aren't selling. And then this fifth one, this one's tough. Airlines. Now, I know the smart money move is to spend your money using your credit card and start traveling the world and flying all over the place. But look, that's for the very select few that have an Amex travel card or a Chase travel card and that can fly all over the place and that can do business travel and all that thing. But a lot of the travel activity slows down significantly in an economic downturn. Businesses don't fly as often when times are tough because they're trying to save on their budgets, especially now that you can have your meetings on Zoom. Vacation travel falls because consumers just don't have the budgets anymore to take their entire family to Florida or Bahamas, right? Activity for travel falls significantly because folks just aren't getting on planes because they don't have the budget to do so. And what happens when you don't get on a plane for a long durated period of time? The purchases of new pieces of equipment, maintenance, and new planes, that falls as well. So who's hit with this? The airline producers like Boeing. Boeing depends on air travel demand, and when times are tough in the economy, air travel demand plummets, and Boeing's new plane sales, they plummet as well. And oh yeah, by the way, a lot of the parts that are used in producing airlines are made in China. So back to the big T, tariffs hitting their costs as well. I want to show you an extreme example. In 2020, COVID, this is when you and me were locked in our rooms and we were playing Call of Duty Warzone and we couldn't travel or do anything. Boeing stock fell an aggressive 60% during COVID. And that's just COVID that led to the economic compression. With Goldman Sachs saying that we are approaching a 45% likelihood of a recession and that being around the corner, you can almost guarantee that air travel demand and demand for these new products from Boeing are going to fall as well. Now, is it going to fall 60%? Maybe, maybe not. But I'm not going to bet the thing is going to whoop. That's my thesis at least. So those are the 5 stocks to where if I have a fresh $100 to invest in the market right now, I'm not putting it in those. But what if you already have exposure to some of these assets in your portfolio today? Well, I'm not telling you to hit the sell button right now. I'm just saying with fresh dollars, I wouldn't allocate to these names right now. Instead, I would just focus on diversifying yourself away from these businesses. Now, look, if you've had these names for a very long time, 1 year plus, and you're not afraid to have a 15, 20% capital gains tax on those gains, of course, you can think about selling and liquidating and sort of crystallizing your returns before the economy gets bad, and then reallocating those dollars into more defensible, better names. Now, you're not a Wall Street pro, I'm not going to assume, so you probably don't know which names to buy. The best thing that you can do that I recommend and that Warren Buffett, even the legendary investor himself, recommends is to just buy index funds.
Buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm, let the tenant farmer run it for you.
So don't bet on one particular sector or company like Boeing or airlines or home building. Bet on American businesses to where you're getting on average a 10.5% return every single year. On average. Some years during a recession, things are down. But on average, things are going up and to the right 10, 11%. That is your best bet. You're not going to be over-indexed into an oil and gas or renewables or auto parts place. diversify as much as you can by having an index fund. And that takes the pressure of also trying to dive into the weeds of these businesses and sectors during a good time and a bad time. So that is the best thing that you could possibly do. But if you're kind of sick of the markets broadly and you're trying to think of an even smarter play of what to do with your dollars, this is the real smart money move. The real smart money move is to try to buy yourself a private cash flowing recession resilient business. I'm talking laundromats, I'm talking pest control, I'm talking electricians, buying a private business that you can own. And in this next video, I'll outline for you guys how literally anyone can find a business, purchase it with little money and little equity down, and own a cash flowing asset today. So check out that next video if you're interested in pivoting from the public markets and starting to own yourself a private cash flowing business. So I'll catch you guys on the next one. And if you enjoyed this video, hit that like button and leave me a comment of what you are doing in the markets today. And I'll catch you guys in the next one. Peace.